All right, all right.
No
No worries, no worries. Well, hello, everybody. Thank you for joining us live here on YouTube. We are going to be talking about tax deductions and credits. If you watched my previous video over the weekend for the $50,000 marketing grant, I'm still a little bit under the weather. My throat is much better. My nose is not running, but I am coughing. So if I get to coughing and I can't stop, I am going to press mute for myself, and Dorcas will take over and get it together. So what we're going to do is I'm going to have Dorcas, if you could just give a brief overview of who you are, how you got here. Okay. And then we're actually going to go through some of the questions that I missed from the live last time. My apologies. I thought there weren't any, but there were a few. So we'll go through those and then I'll make sure that I'm checking for them accurately and answer them on the live. Again, if you get anything of value at the beginning of this, the middle of this, the end of this, if you can like the video, if you can subscribe, I post grants weekly. So definitely subscribe and then leave us some comments. Let us know what you like, what you're interested in. And then that way we can better prepare for our next session next week or weeks after. The feedback is most appreciated. Miss Dorcas.
Yes, so as you see on the screen, my name is Dorcas. I am the owner of Top Tier Financial and Business Solutions. I got here because my background has always been in finances. So I said, hey, let me go ahead and start a business in finances, mainly because I saw so many new entrepreneurs and seasoned entrepreneurs doing a few things that were incorrect and could get them kind of in trouble or either not protecting them. So therefore, Top Tier Financial and Business Solutions was created so that I can help new and seasoned entrepreneurs either build their business, make sure their taxes are correct and they're being filed correct so they don't have to end up going to jail. You know, oh, yeah. I'm also a notary public and I'm also a bookkeeper. So I'm a financial girl and a business girl all around.
Oh, yeah. Okay. Miss Notary, I want to congratulate you on your first course that you just had. So if anybody missed her course, I'm pretty sure she's going to do another one. I'm going to have her information in the comment section as well as the description box. And just quickly tell them what they will learn once you have your next notary course.
So the course, it says that I'm just going to tell you about the back end of it, like the how-tos of how to become a loan signing agent in a notary public and how to turn that into an actual lucrative side hustle to where you could get paid upwards to $200 per hour just doing loan signings and just working on your own schedule. So I'll be teaching in these courses basically the how-tos, the how to become a notary, how to become a loan signing agent, how to handle your profit and loss, making sure that you're an actual profitable business, what signing agencies to sign up with, what supplies you'll need, how your taxes can be handled, how to do your bookkeeping, and so much more in the courses. I actually also have, after you're done with the course, you then get to become a part of the Winning as a Notary Public course group. And so you will have like a continuous knowledge, a continuous mentoring program, coaching program throughout the entire process. That way, you're not just, oh, I took the course and now she just dropped me. It doesn't work like that.
Perfect. So again, I know individuals are interested specifically in the loan signing agent. Mm-hmm. I've seen it a lot on Facebook. I've seen a lot of people offering courses of, the how-tos, but definitely you want to make sure that it's somebody that's actually doing the work versus, oh, I heard about it. Let me tell you what I've learned. Mm-hmm. But the best teacher is experience. So you want a teacher that has the experience, that's able to provide that information. And with that, one of the questions that we missed, it is from Miss Mila. Hopefully I'm saying your name correctly.
Okay.
Her question was, I'm a notary. What would be the best for me to file my company as, because she's just beginning?
Okay. As far as taxes goes.
So we can do both. So what I'm taking away from that, I think possibly taxes.
Okay.
But then as far as if you're going to be an LLC or a corporation, or if you just want to be a sole proprietor, me being an attorney, I would recommend that you want to be an LLC, mainly because if you're a loan signing agent, you're going to be handling some big deals. And if you mess that up, you don't want your house being foreclosed on and taken away. You want to make sure that it's your business that they're going to come after. But more importantly, you want to make sure that you have everything in place when you're starting that type of business, and it's not a side hustle, like, you know, I'm crocheting some hats for families and friends. So you want to be a sole proprietor. But if you're talking about being in a notary field and you all have books that you got to track everything and get IDs, you want to have an LLC. You want to have an entity that's going to protect you. Now, thinking from the accounting side, I don't know.
So, like I was kind of saying in the previous video, as a notary just starting out, you don't want to put that S Corp tax identity status on you right away. Because as you know, well, I don't know what state you're in, but in North Carolina, we can only charge $5 per signing, per principal signature. So if you are, don't take this the wrong way, if you are just a notary public, then you're only going to get paid $5 per principal signature, meaning if you do a power of attorney and it's two signings, it's two people signing, you're only going to make $10 off of that. If you do that and you have the S Corp status, you're kind of screwing yourself from the beginning, because now you really can't pay yourself. You can't purchase the supplies and equipment that you need by paying yourself. So you don't want to put that status on you. Now, as time goes on, you're actually building your business. You're actually you turn into a loan signing agent. You're getting a lot of money. You're bringing in a lot of money. Then eventually you could turn into an S Corp, usually around $50,000 to $60,000 in net profit. That's the amount of money after your expenses. That's when you want to switch over to an S Corp tax identity. But starting out, stay as the LLC sole proprietorship, well, the LLC with the self-employment tax identity.
All right. We have one other question. This is from Miss Mia Stewart. And hers is a general question. Should a sole proprietor get an EIN number? Now,
go ahead.
There's two things. Yes, because, right, you want to protect yourself from identity theft because you're going to have the EIN. However, if you're a sole proprietor and you have employees, then you are required to have an EIN. But I would not recommend having employees under a sole proprietor versus an LLC or corporation or any of those other legal entities. So yes, if you're a sole proprietor, go ahead and get your EIN number. That's going to be beneficial for you if you're going to open a business bank account. Try to get, any of those other things that you want to get from the business side if you're not an LLC. Versus using your social security number. And you want to start building business credit as well, because your EIN, if you change the name, you can transfer that EIN number. So those are the questions that I missed. I am going to be checking throughout. So if we can just start just a general conversation, because I definitely know what deductions are. I make sure I get my deductions. I don't know what credits are. I guess people get, child tax credit. I don't have children. So that's the only credit I'm aware of. So if you can just tell us the difference between a deduction and then a credit, so people can be able to identify them if it's on a piece of paper.
I definitely can. And it is a lot when it comes to tax credits and tax deductions. So just make sure that you do your homework also. I'm going to kind of give you like the gist of it all. But every state has different credits because you have your federal, remember you have your federal and your state taxes. So what I'll be discussing today is your federal taxes, not state, because every state is different. So the difference between a tax credit and a tax deduction. Hold on, let me put it in layman's terms. Okay, so a tax credit is when you take, when you're, it's basically a tax incentive, so that you are creating a tax credit throughout the year so that you can take that tax credit at the end of the year, not to lower your taxable income, but to lower your tax liability. Before I get further into it, let me break down what tax liability is and your taxable income.
Let's try this. Because my lawyer mind is already confused. Okay. So let's break it down for people that's probably a little bit, confused too. So when you say a credit, let's say, what's a type of credit besides a child tax credit?
There's a such thing as a saver's credit, and that's when you pay into your retirement fund. But there's stipulations to it, because if you make over as a single filer or head of household filer, if you make over $60,000 a year, then you can't claim this saver's credit.
Okay. So is it monthly? Can I say, oh, my credit is $100 a month, or it's just a annual lump sum?
It's a lump sum. Okay. So let me try to break it all the way down for you. Okay. Because I know we throw a lot of terminology out there, and it's like, what is she talking about? Because I know if I wasn't in the field, I'd be like, huh?
That's where I'm at right now, huh?
So a tax liability is the amount of money that you owe at the end of the year. Yes. That's what a tax liability is. Your taxable income is the amount of money that is left over after your expenses. Okay. After everything has been taken out, that's your taxable income. So for instance, if you made $50,000 the entire year, this is just an example. So don't try to calculate my numbers. I'm just throwing numbers out there. Okay. So if you made $50,000, and let's say your expenses and your deductions came up to, let's say, $20,000. This is a huge difference, but $20,000. Then your taxable income now is going to be $30,000. Okay. So that would be your taxable income. Now, there is so let's go into tax credits. A tax credit is essentially something that will not lower your taxable income. Meaning your income stays the same. So if you made $50,000, it'll stay at $50,000. But then it will lower your tax liability, meaning the amount that you owe. That's a tax credit. So for instance, if you had a tax credit for $2,000, let's say your taxable income was $100,000. So now you have $100,000 as your taxable income. That stays the same. And then you have a tax credit that's $2,000. Whatever your tax liability was, let's say it was $5,000. That tax credit will come in and eat $2,000 of that tax liability up to drop it down to $3,000.
So now I owe $3,000. Okay. So I need to get a bunch of credits, basically, so the IRS don't get in my pockets twice.
That way your taxable income stays the same. That's especially when you're looking to make huge purchases, like you're trying to get a luxury car, or you're trying to get a house, or you're trying to buy like investment properties or get a large loan. You want your taxable income to stay as high as possible. And so that and then you don't want to owe a lot of money. So it's like a balancing act between your income, your deductions, and your tax credits.
Okay. What are some other tax credits out there? So you told us about the saver's credit. We know about the child tax credit. What are some other credits that aren't, really talked about a lot in mainstream?
You have the lifetime learning opportunity credit. This is for people that continuously go to school, on and on and on. You have the American Opportunity Credit. This is mainly for like undergraduate programs. It lasts for like 4 years. You have the child tax credit, which everyone knows about. You have the dependent care credit. Now, let me remind y'all that it may say child tax credit, but it's a dependent credit. So it doesn't have to necessarily be your child. It's just someone that is your dependent.
Okay.
That's why they call this one not the child credit or the child expense credit. They call it the dependent care credit because it's for dependents. It doesn't have to be your child.
So can your dependent be your favorite pets, or does it have to be a human being?
Has to be a human being.
Okay. Because people, they're pets for their babies, and they will definitely put the pet on there. Now, let's go back to the lifetime one. Only because, okay, I know an individual, and this would have been years ago. This person told me that they stayed in school consistently for a reason, but it's so many years ago that it's vague. But maybe this is why. So can you just explain that a little bit more?
So the lifetime learning credit is essentially where you continuously go to school. They give you a credit for continuously attending school. This is every single year. You can file it for a lifetime. It's not a large credit though. Okay. Usually when people, I'm not going to say that. When people stay in school, their student loans are also pushed back. So the longer they're in school,
I'm aware. That's one of the reasons. I'm definitely aware that that's what's happening as well. It's like, let me just take one class, one semester, every semester. So I'll never pay a student loan, and I'm learning, how to draw, and I don't even care about it.
I don't even care about it, but I've learned this.
So no, I get that, but I'm like, could it be this, this learning? What's it called? Learning tax credit.
It's lifetime learning credit. Okay. It's really not that big of a credit to make you want to continuously go back to school and pay loans. So no, not that. Okay.
Now let's go to the other side of the spectrum.
Deductions,
because I know about deductions. I did all of my deductions. But if you could just talk about the difference now that we understand what the credits are. Now, what's the difference when we're talking about deductions?
Deductions. So tax deductions are essentially what tax deduction is basically reducing your taxable income. Okay. So that it reduces your tax liability, which means the tax deduction is going to eat up some of your taxable income and decrease your tax liability, meaning how much you owe. The bad thing about claiming so many deductions, because, as business owners, we have tons of deductions that we can claim on our taxes. But the bad thing about it is that it's eating up our taxable income, which is the adjusted gross income that we actually need to show in order to make these big purchases later on. And it goes back, and you want to make sure, because they go back whenever you make big purchases, about 2 to 3 years. If you do this year and then you plan on purchasing a house in the next 2 years, it's still going to show as a lower income. So they're going to do a comparison, especially as business owners. This is something that's really important to try to avoid.
And see, that is key. And what I realized, and not from myself personally, but a lot of companies realized how bad of an idea it was to create deductions that weren't real when they got ready to apply for the PPP money.
Yep.
Because now you're saying that your business had made so much money, but when I look at your taxes, it shows that you were getting refunds, meaning that you weren't really making a lot of money, but in actuality, you were creating these deductions because you didn't want to pay taxes. Exactly. And unfortunately, as business owners, that's what we're taught, right? You're not taught to want to pay taxes. You're taught get as big of a refund as you can get, but it's never that conversation on the other end of the spectrum of a bigger refund means that your business is not sustainable. And then let's talk about, I post grants weekly. When you're attempting to apply for grants, they're going to look and say, oh, I don't know, they're not really bringing in any money, and now they're going to get $50,000. Are they really going to be able to manage what we're going to give to them when they're saying that they're only bringing in $2,000, but their income was, let's say, $50,000, but you got all these deductions that's brought it down to this $2,000 because you want to pay the least amount of taxes.
Yep. Girl, you hit the nail on the head, because people look at it and they think, oh, this is a grant, I don't have to pay it back. Oh, this is a grant, they don't look at this, they don't look at that. And that's not the truth. That is a lie. Yes. They actually do look at your revenue, because this is free money that they're giving out to you so that you can sustain a business. And if they see that you cannot already sustain the business that you have and the income that you're bringing in already, why should they give this free money to you when they can go to the next business that's actually grown, that is a sustainable business, and they know that their money is going to go to a good cause and that they're not going to just waste their money. So that's what you have to take into account whenever you think about, oh, I'm about to write all of this stuff off.
Yes.
Exactly. So the thing is, you may see all of these huge companies, make all these big purchases at the end of the year. Like, we got to buy this, we got to buy this, we got to buy this. But you have to take into consideration how big these companies are. So if you have $1 million company, of course, you're going to sit here and say, okay, so we can get all of this new stuff. That deduction that they're creating for them is a very, very, very small equipment expense. And then these equipments can be depreciated also. So they're depreciating assets. So they're not just going out and creating these small things like, oh, we're going to buy some more supplies, we're going to buy this, we're going to buy that. That's not a real asset to your business. So whenever you create these deductions, and yes, you can create deductions, but they have to be real. Like when you create it, you have to actually buy the tangible or the non-tangible item so that it can then become an asset. But whenever you create it, these expenses have to be an asset to your company, not just something that you just created out the blue. It has to be a strategic purchase.
Yes. Now, I know some of us are creating deductions, okay, that we have not purchased, that is nowhere on site. And we're like, look, Uncle Sam said I owe him $5,000. I bought a bunch of paper, I did a bunch of marketing. It's $1,000 now that I'm going to owe Uncle Sam, right? And again, it ties us back to not being able to really strengthen and grow our businesses the way that they should be growing to propel them, because we don't have access to loans. Because I tell people, other people's money is the best money to spend, right?
Exactly.
So if you're trying to get a loan and it's a low interest rate, you're not going to be able to get that loan because your financials are not going to be aligned with what you're asking for.
Exactly.
You're not even going to be able to get the grant. Because, I did get a grant. So I have a real estate company and I was able to get a grant from when COVID happened, because obviously people would let you in their house to show the properties and nobody was selling homes. But the reason that I was able to do that was because my financials showed that I made a profit the previous year and I had to pay some taxes. I was not happy, but I paid Uncle Sam his taxes, and I'm grateful that I did, because it put me in that position to be able to get a grant that I didn't have to pay back. And then, I used it for marketing because I still couldn't, sell any homes the year of COVID. And we're still in COVID, but, first year.
First year.
So, I just think, those are things. But before probably the past couple of years, my mindset was, I don't want to have to owe any taxes. So I need to make sure I got deductions, I got expenses, I have all of these things to ensure that I'm paying the least dollar amount at the end of the year. But I also think, and you can chime in on this one, is like figuring out how to properly plan for that, because I mentally knew, because the real estate market had picked up, and I do have a regular job, and I had sold more homes than I had sold in the previous years. So mentally, I knew to expect that I was going to have to pay something. And I started, putting money aside. Like I didn't spend any of my real estate money because I wanted to figure out what was I going to owe.
Yeah.
But I'm in a different predicament because I'm doing it part-time and I have a full-time job to sustain me. But someone that's doing, let's say, real estate full-time or anything full-time, what would you recommend that they do or set aside to be ready if, you know, you have this huge tax bill at the end of the year?
Yeah. So a few things, and you touched on a lot of really great topics. So the first and foremost thing, we definitely don't mind my eyes. We definitely have to get out of the mindset of, oh, I want a refund, oh, I want a refund, oh, I want a refund. As business owners, if we are intending to grow the businesses that we have and that we have invested our time in, we have to understand that at the end of the year, we are eventually going to have to owe and we're going to have to pay in taxes. If you want these six-figure businesses, if you want these $1 million businesses, you have to understand that you're going to eventually owe. The key to it all is to tax plan throughout the entire year. People say we live to pay taxes. That is very true. But if you tax plan, when that tax time comes, that will not hit you as hard as it would have had you not. Like you said, you started putting money to the side whenever you realize, oh shoot, I'm gonna end up owing at the end of the year.
Yeah.
So as a business owner, we have this thing called the quarterly estimated taxes that you can pay into on a quarterly basis. You should take at least 25 to 30% of whatever you earned and put it into a tax savings account. Do this on either a weekly basis, bi-weekly basis, or a monthly basis. That way that income is already put to the side and you don't have to worry about it. Because self-employment taxes is usually around 25 to 30% that you'll actually owe. So this is the tax that you want to go ahead and put to the side so that you're not stressed whenever tax time comes. Like, oh Lord, I got to pay $10,000, $20,000 in taxes. I ain't got this.
Exactly.
Now it's already in the bank account and you're like, oh, you need $10,000, just pull it out the account. That way you don't have to worry about penalties. You don't have to worry about not having the money or you spent it all. That's the whole point of tax planning. Throughout the year, you create tax credits for yourself. Like whenever you have employees, there are employer credits, there are health savings account credits that you can create by hiring people on. So like if in the real estate industry or in the trucking industry, you hire people on, we'll talk about this at a later session. Yes. But you'll hire people on as your employees. Give them benefits. There are tax incentives for giving your employees benefits. Do these types of things throughout the entire year so that you don't have to stress about it at the end of the year. But when it comes to your quarterly taxes, make sure you're putting this money to the side, and every single quarter you want to pay into the quarterly taxes. So take that money out of the savings account and pay it into the IRS. That's your federal tax payments. You can also do it with your state. The state allows this also. You just need to go to your state's Department of Revenue, whatever it may be called in your state. Go to your state's Department of Revenue and set up a portal on there just the same way you do on the federal website and pay in your quarterly taxes. That way, at the end of the year, you don't have to worry about, oh Lord, I owe this amount of money. Because at the end of the year, so throughout the year, you're going to pay what your revenues have brought in. At the end of the year, what you actually brought in your revenues. At the end of the year, that's when you're going to calculate your expenses and your deductions, and you're going to take that into account whenever you pay your taxes. So if you pay too much in, then you can actually get a reimbursement, or that money that you put in can actually be pushed to the next year.
Now, go back to one word you said.
Yes.
Tax savings account. Is that a special account, or are you just calling it that? I have it in my bank account and I label it.
I'm calling it that.
Okay.
So you need, as a business owner, you need multiple accounts. Don't shoot the messenger. You need multiple bank accounts. So you need your operating account. You need your tax savings account. You need a payroll account. You need a payroll, tax, operating. You also need a contingency fund, which is another savings account. So these are the four main bank accounts that you actually need as a business owner. You need to be putting money in these every single month.
Okay.
Okay.
Now, let's talk about some deductions. I know we talked about them briefly in our last video, but I think it's good to, speak on it again in case somebody hasn't watched the video. I highly recommend going back and watching that video because it's a high level of, if I'm an LLC, if I'm an S Corp, all of these things. S Corp is a tax election. Okay. It's not a separate entity. So, but going back and looking at that, and then you'll have a better understanding of why we're having this conversation now. But like you mentioned in the last video, marketing is one that people just don't think about. But what are some other rare deductions that individuals are probably leaving on the table?
Okay, so it is a huge list.
Yeah. Just give us a few of them, and then they can reach out to you for the full list to get their taxes done.
All right. So essentially, anything that is ordinary and necessary for you to run your business is a tax deduction. So for the trucking and real estate industries, our dues, our memberships, our subscriptions, all of these are tax deductions. Point blank, period. Our photo shoots, our commercials that we create, they're tax deductions. Our supplies, if we need particular clothing for these businesses, they're deductions. Let's see. A part of our home, if we have an in-home office, that's a deduction. The gas, the mileage, that's a deduction. The vehicles that we have, if we have a particular car for our real estate business or our trucks, they're depreciable assets, which in turn create deductions. They create expenses for us. So all of these things are deductions for your business and can be written off. The other thing is charitable contributions. Okay. They're deductions. So if we donate clothing, if we donate shoes, if we donate items out of our home, these are all deductions. Yes, they only take a certain percentage. They only take a certain amount, not percentage. They only accept a certain amount, but it's still a deduction that is created for something that we do on a normal basis.
What about sweat equity?
As in the time?
Yes, my time. Can I get a deduction for that?
You can't get a deduction for your time.
Well, it's valuable, so.
It is valuable, but it's not a deduction.
Okay, and that's a good point. Going back to the real estate industry, because, individuals that are in like the, $1.5 million homes that they're selling, and you gotta wear, you have to present yourself as luxury. Exactly. To be able to know that that's going to be a deduction. If I spent, $700 on some shoes, or I went and bought, I don't know, a Mercedes or whatever it is, so you can pull up looking like luxury or money, etc., for the clientele that you're attempting to get. So I think we sometimes forget about those things as well. Yes. So it doesn't just have to be the real estate. Whatever it is, if you're a consultant, if you're a public figure, that's what I was about to say. Like, if you're somebody that does a lot of public speaking, and if you're a male and you got to get, Italian suits that's tailored to a T, and traveling expenses and business lunches, as she said, anything that's like necessary and ordinary. But and even from a layman's person, but for the fact I have this company, I wouldn't have this expense. So if I wasn't a public figure and I didn't have this public speaking engagement for my business, I wouldn't be here. So therefore it's going to be a deduction. So just remember to think about every single penny that should be a deduction. That's actually a deduction, because we want to grow our companies and become six-figure earners, and not, saying that we only made $2,000 a year when we cash out in $100,000 and can't do that no more. And we're going to talk about that next week, actually. So next week, while I just brought it up, we're actually going to take a deep dive into the $600 1099K rule that has already come out.
Mm-hmm.
Most people are aware of it, but I think there's a lot of misinformation that's out there about how you can avoid it, how you can legally not pay. And as she started off, we don't have no bond money, bail money for nobody. So
exactly,
we need y'all to follow the rules.
Yes,
because it's not going to be worth your livelihood. Your family's coming to visit you because you're trying to avoid paying taxes, which is something that you should want to do anyways for your business, and to ensure that you are able to apply for some of the grants, loans, different dollars that's out there for you. Because at the end of the day, you getting, circumventing the system today is probably going to prevent you from making that $1 million tomorrow.
Exactly.
So you got to have a millionaire mindset.
Exactly.
They pay taxes. Do they avoid them? Absolutely.
Yes.
The person believe they pay them.
But see, the thing about it is that they have strategic partners on their side to where they can avoid paying it. Like, for example, should I say that? For example, some of these companies.
Yes. We already know where you was going because it's everyone's number one example. Yeah. We don't name names, but you know who we might be talking about.
Some of these companies, some of these individuals, they can be millionaires and they only owe $50,000 in taxes. And to them, that's like a penny.
Right.
But it's because they have a strategic partner on their side that actually teaches them the game so that they only owe this 50 grand. But you see, their income is still high. And that's the whole part of it. Tax planning is the key to it all.
And you got to have the right team, like you said, because what we discussed prior to, even putting this together and just in the planning phase is that the lawyer and the accountant is always left out of the strategic plan when somebody's about to start a business. Everybody else is considered. The lawyer comes in when there's a problem. The accountant comes in when the IRS is knocking at the door saying, hey, what's going on? You haven't filed your taxes or you filed them wrong. You owe us this type of money. So definitely pay the most important people on your team to keep your team afloat.
Exactly.
And that's why these larger corporations are able to legally circumvent Uncle Sam because they're busy running their business while the expert is doing what the expert does. Yeah. But and if this is what you have to be right now, totally get it. One-stop shop, you're all things encompassing your business. However, when you're coming up with your budget, it should be a budget, even if it's to quarterly have your accountant or CPA, you do everything on your own, but quarterly send stuff to them so they can make sure.
Review it. Yep.
Yeah. So I think that's very important if you're at a minimum able to do that. So you're not at the end of the year like, oh crap, what just happened and how am I going to get through with this?
Or at least have someone that is on retainer. Like these Fortune 500 companies, they have a lot of people. They have their attorneys, they have their CPAs, they actually have tax lawyers on standby in the event something does happen. So even if, let's say for instance, you're just starting out, you don't understand, that's what collaboration means. That's what networking means. Network with individuals that you can eventually one day be able to pay these individuals. But in the meantime, y'all can become a friendship to where you can pick her brain, she picks your brain, and y'all have a collaboration, y'all have an understanding of where you currently are. And then as you grow, then you start paying these people. You actually pay them their work. So don't just be stuck in your bubble. Actually network with other individuals. Actually collaborate with other individuals, because that's what's going to help you grow your business to those 6 figures.
And another thing, don't be afraid to barter your services. Okay. Because what I've realized, and I'm going to have a link to the Money Time group in the description box. And I made a post because, we put a lot of free information in there. And I made a post saying, what is a service that you need? And then what is a service that you're willing to provide? Crickets. Okay. Crickets. Now, when there's a post and there's free information, who needs this, who wants that, we're all ready to take.
Mm-hmm.
It's okay to barter your services if you're going to get something that you need. It's okay to share, a little bit. I'm not saying give away everything for free because people got to eat.
Exactly.
However, in order to get people on your team, they got to know what you offer.
Exactly.
Right? They got to know that, okay, I can trust this person. We could barter. We can do something. So don't clutch the knowledge so close to your chest that you're on an island by yourself trying to operate a business, whereas you could have somebody that would be willing to collaborate, which is how I'm able to do these sessions every Monday. I'm collaborating with individuals and they're willing to give their information to everyone for free. I'm still giving information for free for now.
Mm-hmm.
And, but, I think, again, you have to start thinking like a business person.
Yep.
And networking isn't just exchanging business cards. Networking is sitting and having those deeper dive conversations about what does a person do? Because yes, I'm a lawyer. Yes, Dorcas is a CPA. However, I would have never known that she does notary, that she trucking, real estate, and no one's going to know that, real estate, professor, boutique, etc., because we're not having those conversations and realizing like, wait, let's barter some things because maybe I'm not in a position to retain Dorcas for a year. Or maybe I can draft some contracts for her. So really look at like, because you got some skills that somebody wants. Okay.
Exactly. And I'm all for bartering services.
Yeah.
All for it. Yeah. And whenever you do network, don't, because I've seen this a lot. Whenever you do network, don't just immediately say, I do this. You can schedule consultation. You actually want to have that full conversation. If there's something that you can provide to them, you have to build that know, like, and trust factor. And you have to actually hold that conversation with them so that they can see, she's for real. She's not just so-and-so. And like an example of this is like, I went out, this is an old way of networking, but it ended up being fun. I went out to the mall this weekend. I almost got locked up, girl. Because I was handing out my flyers in the mall.
Okay.
And I was handing them out. I was holding the conversations, and I had a few people just like, they wanted to actually hold a conversation about their taxes because, tax season is here. And I didn't say, you need to book a consultation with me. I said, okay, so let's talk about it. What's going on with your taxes so that you can actually build that rapport with that person. And then the next thing you know, they actually do book a consultation and they become your client. So don't just come up and say, I do this. You can schedule a free consultation with me. Actually hold a conversation with that individual, laugh with them, talk with them, see if you can actually solve their problem.
Yes.
That's how you build those relationships.
I think that is the most important. When I first started off, I used to feel like, okay, I'm telling people all this stuff and they're not booking with me and they're just stealing all my free information. And now you like fast forward to people are now reaching out for your services, but it's because now enough people know who you are because of those conversations. So essentially you got to plant those seeds. And trees don't grow overnight.
Exactly. Because believe it or not, people are literally watching you. Like when they add you to their Facebook page or they join your group or they like your actual business page, they're actually watching you. They want to see consistency. They want to see that you are knowledgeable in what you do, how you do it, that you provide great services, that you have good quality items. So whenever you do that, you can still give free game every now and again. Don't give everything out.
Please don't.
You can give free game, but you want to give free game that is actual information that actually helps them solve the issue that they may have. And then in turn, I actually had a few people tell me, I've been watching you this whole time. I just wanted to vet you.
Yep.
That was it. And then they became a client.
Mm-hmm.
So that's just a part of the game. That's just a part of the business. You just have to stay consistent. And then those people that you thought, oh, they're not going to buy anything, now these people are actually your clients.
Yes. And that is true, because I watch a lot of people on social media before I even attempt to reach out and be like, hey, you want to talk about this on this YouTube channel? And just because I don't become your client, like I've already referred so many people to reach out to you, right?
Yep.
Even though I'm gonna be a client, but before I was gonna be a client. But those things will happen. You know, I refer people all the time, and it's merely off of I have been watching them on social media, and I'm like,
exactly,
hey, this person knows what they're talking about. I'm watching how they engage with people when they ask questions. So it's not just about what you post. And there's some individuals where I was thinking, oh, they know the information, but then I'm watching how they're engaging with people, and I'm like, I can't refer anybody to that because that was just a little too messy for me, right?
Exactly.
So you have to remember, you're always being watched, and you never know who you're talking to. So you gotta open your mouth. And as we said, with the bartering, or even if you started to have a conversation with someone, like if somebody was to start to have a conversation with me, and I don't even tell people that I'm an attorney. The only reason I do it here is because I have to legally. But otherwise, I don't. I just have regular conversations with people. And then if somebody started to have a conversation about, I don't know, starting a business, I will still just talk to them with the intel that I know, but I never say, oh, I'm a business attorney. I'll just say, oh, I mean, are you trying to amend your LLC? Like, what are you trying to do? Oh, if you need some business grants, definitely check this out. So we're having a conversation. So they become interested in Ebony, the person, and not, oh, she's a lawyer. Let me try to, really
get some information.
Intel, because I want you to like me, right? And I want you to trust me. I don't want you to trust the title, because it's some crooked lawyers. I'm not one. They exist. Okay? So just think about that. And I want to make sure there aren't any other things that we should think about.
There is one.
Please tell us.
Boy, it is a lot, but
tell us.
Let me give me 1 second, because it is a lot, which is why I actually pulled it up for this particular situation, because it's very important to understand, because there are such thing as refundable credits and non-refundable credits. I'm probably throwing a whole wrench in this whole situation.
I've never heard of it.
I'm sorry, y'all, but I do want to let you know about the difference between the two, because some of these credits can be claimed. Some of them cannot be claimed depending on what your taxable income is, which is why it's very important to not write everything off. Okay. So a non-refundable credit. Okay, we all know what a credit is. A non-refundable credit is essentially a credit that cannot create a refund. Okay. What that means is that if your taxable income is $0, so some people file taxes with $0, expect their money back because they have a child tax credit, right? So if they are at $0, a non-refundable credit will not create a refund for you. A few examples of this is the Savers Credit, the Lifetime Learning Credit, and Adoption Credits.
Okay. So wait. So I got zero income, then I have a child tax credit.
The child tax credit is a refundable credit.
Okay. So if I got zero income and I only have these other ones.
And you only claim the non-refundable credit.
Got it.
If you have no taxable income and you're claiming non-refundable credits, you will not be able to claim them because you don't have anything that is that is able to be taxed. You have no tax liability. Therefore, they cannot create refunds.
Makes sense.
All right. So refundable credits are credits that create refunds.
Okay.
Okay. So these credits are the earned income credit, the child tax credit, the American Opportunity Credit. These are all examples of them. Okay. These tax credits will create a refund. So, for example, if you have, let's say, if you make $26,000 and you were going to get a tax refund for, let's say, $10,000, you're already at the point where you're getting a tax refund. So we're not really able to tack on a non-refundable credit. Because it is a refundable credit for something that you already have or you already created, these refundable credits can then create additional income, an additional refund. If you're at $10,000 and let's say, for example, the child tax credit is at $2,000, that's going to bring your refund up to $12,000.
Got it.
Okay.
I am following.
Good. I just wanted to hit that mark because I know, and I've seen it before. I know a lot of us are like, well, dang, I wasn't able to claim that credit. I wasn't able to claim this credit. Wasn't able to claim this credit. And I'm at zero tax, but it's a credit. So why can't I claim it? It's because there's a difference between a refundable and a non-refundable credit. And if it's a non-refundable credit, then you can't claim it with a zero tax liability, which is usually the case whenever you're getting a refund.
Okay. So the non-refundable credits that you've mentioned, are they always non-refundable?
Yes.
Okay, got it.
But
oh Lord. Okay.
Tax law, I'm gonna tell you, tax laws and tax codes change all the time. Matter of fact, last year in the middle of tax season, they brought out a new tax law. So I mean, it happened. So some non-refundable credits can turn into refundable credits.
Gotcha. Now, now I know in the last session you said, you was doing free consultations for the whole tax season, and tax season ends on the 15th.
Girl, don't.
I know it don't. That's why I'm like, I'm gonna ask again.
No, I am doing free tax consultations until April the 15th. That's my last free tax consultation.
So it's still the 15th. I thought maybe since we did get an extension this year again.
No, I may do it. As of right now, I'm only doing until April the 15th.
Okay. And then how do they get in contact with you for a consultation? And do you have slots still left?
Yes, but they are filling up really, really, really fast. Usually they fill up on a weekly basis.
Okay.
I do have a few consultations that have gone into like the end of January into February.
Okay.
But they really do fill up fast because everyone calls me on either a Monday or on a Friday and they want to book something the next week. So if you want to schedule a consultation, just go to my website, top tier, F as in Frank, B as in boy, S as in Sam.com. That is toptierfbs.com. I made it really simple. That's where you can catch me on all platforms. And just go there at the very top. As soon as you go to my page, you can click on schedule a consultation and just click tax consultation and it'll direct you to choose a date and time that is best for you and you'll be set.
Okay, so if you got anything out of the video, please like it. Please subscribe so you can know when these grants are coming out. There is a grant that I posted over the weekend. It's a $50,000 marketing grant. If you're a nonprofit and want to work with a for-profit want to work with a nonprofit, it's a collaborative grant. The deadline is this Friday, but the application is extremely easy. Leave us a comment if there is anything that you would like for us to discuss. Know that next week we are going to talk about the $600 1099K, and then we will discuss what we were supposed to discuss next week. We're going to do
W-2s and 1099.
Yeah, employee versus independent contractor, will be the following week, only because, like I said, so many people have questions and it's already January 10th, and some people might have already got their $600 cash apps trying to, circumvent. But other than that, I want to thank you, Dorcas, for speaking with us again. It is always a pleasure.
Thank you for having me.
I will put her information in the description box, in the comment box. We will be back here next Monday, 6 Central Time. And thank you all in advance for watching, liking, subscribing, commenting. All of that is amazing. And I hope you all got some good information. And enjoy the rest of your evening.
Bye.
Bye. See you next time.